In this video, we are going to talk about 20 dividend stocks for cash flow. So before starting this video, please like this video and subscribe to this channel for our future updates. Number 20. Realty income. Realty income pays monthly dividends, making it an attractive investment for retirees. Realty income has paid a dividend for 609 consecutive months, which is one of the best records in the industry. Walgreens, FedEx, and Walmart are among the 600 tenants in the company's over 6,600 commercial assets. Buildings leased to tenants with investment-grade ratings account for over half of Realty income's rent. Number 19. Verizon. Verizon Communications, unlike AT&T, has recently focused on its core wireless business. In actuality, the company restructured in 2018 to better focus on the development of 5G services, and it recently announced a $5 billion sale of its AOL and Yahoo holdings to Apollo Global Management, APO. Investing in network quality allows RootMetrics to rate the company for wireless reliability, speed, and performance. Verizon has a significant subscriber base due to the non-discretionary nature of its offerings. Number 18. Universal Health Realty Income Trust. Universal Health Realty Income Trust, UHT, $66.93, has 72 healthcare properties in 20 states. Medical office buildings and clinics account for more than 70% of its portfolio, decreasing risk by reducing reliance on federal and state healthcare programs. However, UHT also owns hospitals, independent emergency rooms, and childcare facilities. Universal Health Realty Income Trust originated in 1986 by purchasing properties from Universal Health Services, UHS, and leasing them back to UHS, which is still successful today and accounts for around 20% of the REIT's revenue. Number 17. National Retail Properties. National Retail Properties has increased its dividend every year for the past 31 years. Only 86 companies out of over 10,000 have increased dividends for the same time or longer. Over 370 retail tenants, including 7-Eleven, Mr. Car Wash, and Camping World, are leased to this REIT's 3,100 freestanding properties, CWH. E-commerce resistant businesses like convenience stores and restaurants account for only 18.2% of total income. Number 16. Ennis. Labels, checks, envelopes, and presentation folders are available from Ennis, EBF, $21.29. The company, which was founded in 1909, now services over 40,000 global distributors. Ennis has carved out a solid position in an increasingly digital market by making 95% of its commercial items to order. It's also a varied company, with no single client accounting for more than 5% of total revenue. Number 15. Chevron. Chevron is arguably the best positioned and most committed oil corporation to continue paying its dividend in these challenging times. At the end of 2019, the company's net debt-to-capital ratio was 13%, much below the industry average of 20% to 30%. Chevron executed a smart all-stock acquisition of Noble Energy to take advantage of low oil prices. Number 14. W.P. Carey. According to W.P. Carey, it has operationally critical commercial real estate in its portfolio. In the United States and Europe, W.P. Carey has over 1,200 industrial, warehouse, office, and retail properties. About 350 long-term tenants occupy the company's premises, with 95% of lease agreements containing rent increases. W.P. Carey's activities are also well diversified. Around 40% of income is generated outside of the United States, its top tenant pays only 3% of the rent, and its largest industry exposure provides about 22% of revenue. Number 13. Pembina Pipeline. Since its IPO in 1997, Pembina Pipeline has been paying dividends. Transports oil, gas, and natural gas liquids, NGLs, primarily across Western Canada. Pembina's business approach, which is built on long-term fee-for-service contracts, has allowed the company to maintain stable payouts in volatile energy markets. Number 12. Enbridge. Enbridge owns a pipeline and storage network that links North America's major oil and gas-producing regions. ENB is in a defensive position, even if the energy climate remains difficult. E&B is capable of self-funding both its expansion capex needs and its dividends from operating cash flow, removing the need to rely on external capital markets, according to CFRA analyst Stuart Glickman.
Number 11. Enterprise Products Partners LP.
Enterprise Products Partners LP is a large midstream energy corporation with a market capitalization of $23.27 billion. The corporation owns and operates pipeline infrastructure, storage facilities, processing units, and export terminals. This MLP has connections to all major shale basins and refineries, allowing NGLs, crude oil, and natural gas to be transferred from upstream producers to downstream users. Fee-based activities generate the enterprise's gross operating margin, limiting its sensitivity to shifting energy prices. It also has one of the best investment-grade credit ratings in the sector, BBB+, and a conservative payout ratio.
Number 10.
Public Storage. Public Storage was established in 1972 and has been paying dividends since 1981. Due to low operating and maintenance costs, self-storage warehouses have a large cash flow. Few customers are willing to switch to a competitor facility in order to save money, resulting in switching costs.
Customers have traditionally placed storage rent payments at the top of their priority list.
During the Great Recession in 2007 to 2009, the delinquency rate was around 2%.
In April 2020, the COVID-19 pandemic had a similar impact on public storage. Number 9. Omnicom. Omnicom has been paying dividends since 1986 when it united three major advertising companies. Over 5,000 clients in 70 countries are served by the advertising and marketing agency. No single industry accounts for more than 16% of total revenue, and over 45% of sales are generated outside of the United States, assuring worldwide diversification. Many clients choose to work with a small number of firms in order to maximize their bargaining power and marketing budget efficiency. Omnicom, being one of the world's largest agency networks, is in a unique position to service customers all over the world. Nonetheless, as the use of digital media expands, marketing is evolving. Number 8. Old Republic International.
Old Republic International has increased its dividend for 39 of the 79 years it has been in existence. Given the cyclical nature of the sector and the severe competition that exists, such a track record is impressive. Nearly half of Old Republic's revenue comes from workers' compensation, trucking, house warranties, and other lines of business. For 14 of the last 15 years, Old Republic's general insurance activities have generated underwriting profit. Title insurance requires little capital and has modest losses, allowing for a wide range of revenue diversification and lower underwriting volatility. Number 7. Toronto Dominion Bank. The Toronto Dominion Bank is one of Canada's largest banks. Fee-based operations such as insurance, asset management, and card services provide for the majority of the bank's revenue. TD is less exposed to riskier, more cyclical areas like investment banking and trading than most large banks. TD has a large base of low-cost deposits thanks to its extensive reach and retail network. This allows the bank to offer new products while also allowing the company's lending activities to generate a healthy spread.
Number 6. Monmouth Real Estate Investment Corporation. Monmouth Real Estate Investment Corporation is one of the oldest publicly traded real estate investment trusts in the world.
The majority of Monmouth's 121 industrial assets are leased long-term to investment-grade tenants, 82% of revenue.
Monmouth's tenants include Home Depot, Kellogg, and Coca-Cola, KO. Number 5. Duke Energy.
Duke Energy has a consistent dividend payment. In truth, for the past 95 years, the regulated utility has paid a cash dividend on its common shares. On Simply Safe Dividend's list of recession-proof companies, Duke is one of the best. In 6 Midwestern and Southeastern states, the company serves 7.8 million retail electric customers. In the Carolinas, Ohio, Kentucky, and Tennessee, Duke Energy serves around 1.6 million people. The majority of these places have strong regulatory ties and consistent populations.
Number 4. Pinnacle West Capital Corporation.
Arizona's largest and longest-serving power company is Pinnacle West Capital. The regulated utility gets around half of its electricity from renewable sources. It has been given a rating of hold by the majority of people.
Number 3. Washington Trust Bancorp.
Washington Trust Bancorp is a bank based in Washington.
But don't be fooled by its diminutive size.
Washington Trust is the nation's oldest community bank and the largest state-chartered bank in Rhode Island.
Washington Trust makes a lot of money through wealth management and mortgage banking services in addition to financing.
Over time, these businesses create more steady revenue.
Number 2. Consolidated Edison.
Consolidated Edison was founded in 1823 and serves a population of 10 million people in New York City and the surrounding areas. Around 90% of earnings come from regulated utility operations, ensuring steady returns over time.
Because of New York's ongoing energy needs, CONE has boosted its dividend for 47 years in a row.
Among the S&P Wink with tongue sticking out 500 utilities, this is the longest streak of yearly dividend increases.
Number 1. Southern Company.
Regulated utilities pay out large dividends and have steady growth rates.
Utility stocks make up a big portion of retirement investments.
Since 1948, Southern Company has paid dividends on a regular basis.
In the Southeast and Illinois, the firm serves a population of 9 million people. While Southern has seen some recent setbacks as a result of delays and cost overruns on clean coal and nuclear projects, it remains financially strong. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.